Las Vegas has seen gargantuan increases in its housing market over the past few years, but now the situation does not look so bright as the city has one of the fastest cooling housing markets in the United States. Will the trend continue? What is the current market situation and what are the future prospects? Stay until the end to find out this and many more, as all of the presented information is backed via the most credible sources and as always said with educational purposes and is not meant as financial advice. Let's begin our analysis. One significant indicator for the lack of demand is the days until closing data. The market is opening more and more options to buyers and sellers are lowering their prices for the first time since 2020. In September of 2022, 56.8% of homes were on the market for less than 30 days, which is still high and shows the demand is still strong. But it is much weaker compared to a year ago when 83.8% of properties had been on the market for less than 30 days. This opens up possibilities of home buyers to start negotiating. According to recent data from the Las Vegas Realtor Association, local home prices have fallen for the fourth straight month in September of 2022. The biggest drops are experienced in southern Nevada. The association reported that the median prices of a single-family house sold in South Nevada for September was $450,000, which is flat compared to August. The record was set in May of 2022 with prices hovering around $482,000. Although the median home price is still 10.7% above last year's prices. Still, the current prices are 4 times higher when compared to the lows seen in 2012, when median home prices in Vegas were only $118,000. In September of 2020, prices were $337,000. In September of 21, prices were $406,000, and in January of 2022, they climbed to $435,000. The most important factor when it comes to home price values is the supply and demand dynamics. Currently, there is multiple times higher supply compared to a year ago. Today, there is a 4-month supply of housing, and a year ago, there was only 1.1 month worth of housing supply. The months of supply is a good indicator of whether a particular real estate market is favoring buyers or sellers. Typically, a market that favors sellers has less than 6 months of supply, while more than 6 months of supply indicates an excess of homes for sale, and this favors buyers. In September, 97 homes sold for $1 million or more compared to 110 homes in August, a fall of 13 homes. The median sale price in the luxury market for July decreased to $1,277,000, and in August that number was almost $1,400,000. This is a $120,000 decrease in the median sale price. When it comes to specific parts of Vegas, the prices are as follows. The median list price for East Las Vegas homes are sitting at $319,000, trading up 25.3% year over year, while North Las Vegas has prices of $429,000, trending up 16.2% year over year. Using open data from Zillow or other providers, researchers Ken Johnson and Eli Berecha have developed a methodology to score the top 100 most overpriced or underpriced metropolitan cities in the United States. And here are the 10 most overpriced cities in the US according to their methodology. Las Vegas ranks the 6th most overpriced city with an overvaluation of about 58%. while Florida has the most cities in the top 10. On the next chart, we see the Vegas trend line and the current overvaluation according to the model. As we can see, before the pandemic started, we were not so overpriced, and for a period of about 6-7 years, we were actually below the model's expected fair value price. The massive money printing and low interest rate levels seen in 2020 and 2021 made the market very overpriced. Let's now discuss the rents in Vegas. The typical rent in the Las Vegas area last month was just over $1,890, up by about 8% from a year earlier, compared with a 25% year-over-year rent hike in August of 2021, according to figures coming from Zillow. For apartments in southern Nevada, rents are up 3.1% this year, down from a 22.5% price jump last year. These prior increases of more than 20% are astronomical and dwarf anything which has happened in the past. The biggest factor for the increases in rents is the vacancy rate. A lower vacancy rate leads to higher rental price increases, and vice versa, higher vacancies lead to lower rents. The price growth is slowing amid increased availability, as Las Vegas' apartment vacancy rate is now 7.3%, up from 5.4% last year. On the next chart, we can see the rental price increases in Vegas in relation to the average US increases over the last 2 years. The peak year-over-year growth was seen in October of 21, when rents increased on a yearly basis by 26.89%, quite astonishing. Although still increasing on a yearly basis, we can see the trend is reverting. The most important factor when it comes to housing is the 30-year fixed US mortgage rate. The following chart shows how this rate has skyrocketed to close to a 20-year high. This has made it so that the mortgage payments for an average US home have gone up by about 100% over the course of 2022. This is the fastest increase in history, and it is the biggest indicator which supports a potential massive and again a historic crash of the property market. The low rates tricked millions of people to buy a home which they cannot afford, and as the US is most likely going to enter a recession in 2023, these people may lose their jobs, and one of their first moves will be to sell these unaffordable homes. Another way to analyze the overvaluation of the property market is to examine the home price to income ratio. The average ratio for the US market throughout history was between 4 to 5. On the next chart, we can see how this level has changed over the last 70 plus years. The current level is sitting at 7.68, while the all-time high was reached in June of this year at about 7.78. This means that we need 7.68 years of full median income to buy an average home in the United States. From this perspective, property prices in the US are between 60 to 70% overvalued from a historical context. But let's examine specifically Las Vegas. The average Vegas salary per year is $59,600, while, as we mentioned earlier, the average Las Vegas home price is about $450,000. When we divide the two, we get a price-to-income ratio of about 7.55, which is a bit lower than the average for the US. So with this in mind, coupled with an insanely high mortgage rate levels and the valuation model developed by Ken Johnson and Eli Berecha, Las Vegas prices could fall with about 50 to 60%. Overall, the current data that we have is showing us that Las Vegas home prices are historically overpriced. Current home buyers must be very careful with their entry into the market, as their purchases could be underwater for several years to come. With this, we end our video. Subscribe for more in-depth analysis covering various topics and comment down below which other assets and sectors you want me to cover next. Make sure to hit the notification bell so you don't miss out any of the upcoming videos. Goodbye and until next time.